Hello, everyone. I'm Angelo Robles, host of the Angelo Robles podcast. I'm also the founder and CEO at Family Office Association. I am really looking forward to today. Now, I know it seems like I say that all the time. It's because I have great guests on, but today's a little extra special. Michael Saylor on economics, Bitcoin, and decision making. Of course, that features Michael Saylor, founder, chairman, and CEO of the public company MicroStrategy. Unless you're living completely isolated, even if you're not active in Bitcoin, you have to have heard of Michael because he's doing things that really no one has ever done and really changing the dynamics of finance, economics, corporate balance sheets, and obviously digital assets. On that note, Michael, welcome to the show.
Thanks for having me.
Really excited to have you on. As my audience knows, with some of the great economists and macro thinkers that we have on, I'm just fascinated by their background, how they come to their critical thinking, decision making, avoid confirmation bias. So lots to discuss. My first question to you, what's the most important thing that you learned as a student at MIT?
You know, I studied aerospace engineering, and I also studied the history of science. So I think the compelling takeaway from aerospace engineering is it's systems engineering. You're integrating all sorts of disciplines in order to create a mechanism that works. And so that gave me an appreciation of engineering under constraint. And I think the history of science is all about paradigm shifts and how when you introduce a new material or a new way of seeing the world or a new technology, it upends the status quo, generally being rejected for a long period of time until it's accepted. You know, so I think when I left MIT, I had a decent appreciation for the importance of holistic engineering, but also for the ability to make the world a better place with new technology.
If you could go back in time, a common question, and talk to your younger self entering MIT, what would you have told yourself so you could have been more prepared to get even more out of the experience and the education?
Well, you know, I think looking back over the 30 years, I guess I left in 87, so slightly more than 30 years. What I realize today is statistics is probably one of the most valuable of the mathematical disciplines. I don't have occasion to exercise calculus of variations that often. So certain forms of math get programmed and we have computers do it for us. But other sorts of math, you have to rely upon every day, every hour of the day in your head. And probably the most common thing is just practical application of statistics, stochastic outcomes, what's likely to happen, and using statistics to decide what metrics to focus upon. Because I feel like, you know, for example, in the world, if I give you 100,000 assets and I keep track of the volatility and the return of the asset every minute of the day, every hour, every day, every week, or every month, I generate a huge amount of information, all of which is irrelevant. And only a practical appreciation of statistics will remind you that 99.99% of all the information in front of you is irrelevant. And so I probably would have spent more time on statistics. I wouldn't stress out so much about being able to, you know, solve the orbital mechanic exercise, you know, for a satellite, because that stuff gets programmed.
And I get this question a lot. I'll make it a little bit personal. He's going to get a little embarrassed, but I mentioned it a couple of times already. I have a nephew that is at a good school. He's doing great. He's a junior, going to be a senior. He's doing some internships, and he wants to be in the world of finance, whatever that may be. Who knows, maybe a hedge fund manager, a banker, a financial advisor. He sends me his resume, and it's proficient. But I'm like, I mean, honestly, there's millions of people who want to do that, and it's a little boring. So you want to get in the world of what we're talking about. Are you learning in school or on your own about digital assets, about whatever, psychedelics, biotech, deep technology? The answer was no, no, and no. How would you recommend to a young person in business and finance when they're maybe not at a top 15 school? How are they going to stand out among the competition if they want to be involved broadly in the world of finance?
Well, I first of all would say you want to, if you want to really be involved in the world of finance, the number one thing to do is figure out Bitcoin and understand the basis of crypto asset network, because 7.8 billion people are using money that's toxic, and the nature of money has been bifurcated, and now the medium of exchange portion of money is sitting in fiat currencies, and the store of value element of money is now migrating into crypto assets and into Bitcoin in specific. So everything you'd study in finance is going to be rendered largely irrelevant in the next 10 years unless you really grasp the underlying theory of money. I think that the best way to learn that is probably not in school at all. The truth is you probably should go on YouTube, and you should, if you go to hope.com or the like, you'll find an entire set of videos on this. You can learn anything in YouTube. A lot of university courses are 10, 20, 30, 40 years behind the times, and there's a lot of inertia in them. But if I told you that somebody invented something 10 years ago that obsolesced 50 to 90% of the finance industry in the last decade, you would say, what is that thing? Well, that thing is Bitcoin. And so I wouldn't stress that much about being in a top 10 school or not being in an Ivy League school. I think that today you can get cutting edge insight just going on the internet, and once you figure out what you want to learn, you can teach yourself. In fact, you can teach yourself, you can bend time and space. I can go anywhere on earth, anytime on earth, pull up a streaming video and watch it at 2x or 150x, skip through it. And so I almost look back on my college education and I think sitting in a classroom, listening to things at the time scale of 1 minute equals 1 minute, and going through a semester at the same rate as everybody else, subject to the syllabus of a single professor, is a very crippling way to learn and for the mind to develop. So in a way, we have opportunities that are better now.
In terms of that, would you say, so you said focus, you would, to your younger self on statistics. In theory, although MIT is a great school, you could have learned that and amplify that at many other universities. Was the main aspect of going to MIT was one, either a boost to confidence that you got there and you were thriving, or the people around you and the lifelong connections, more so than the actual education?
The number one thing I got from MIT was confidence and the ability to think for myself. That's the number one thing. My first serious formative memory of MIT is I walk into a material science class. There's 350 people in the lecture hall. The professor walks out and he is a consultant for NASA. And he's the top of his profession. And he designed these tiles that went on the space shuttle. And he takes one of the tiles and it's burnt. It's got streaks on it. He holds it up in front of the class. He says, on the space shuttle's last reentry, this tile burned off the space shuttle. Nobody at NASA knows why, and we're not sure how to fix it. What do you think? Okay, and this is the first class, the first week, freshman year. We're all 18-year-olds, and it's a bunch of people that are like the class valedictorian from their various schools. And everybody looks at everybody, and there's a pregnant pause for 60 seconds. And you could see what's going on in people's minds, because first they're like, oh my God, is there a reading I missed? And the second thought is, wait a minute, the answer to this question is not in the back of the book. And the third, and then at some point, someone raises their hand and says, well, maybe we should reverse the composite lattices or change the material to something. And everybody goes, oh my God, that must be the bravest student in the world. And it dawns on all of us that this professor, who's the smartest in the world at what he does, working for the leading space agency in the world, doesn't have an answer to a fundamental problem. It's never been answered in the history of the human race. He's looking at a bunch of people. He expects you to think for yourself and figure it out. And he thinks maybe you can. And that idea that you can actually solve a problem for the first time in human history, and you're expected to do it, and they're going to give you all the basic tools, the math, the engineering disciplines, the scientific method to do it. I think that's enormously confidence building at the end of the day, because the number one thing you want to learn from your education is how to think, right? How to solve problems. After that, everything else is useful. It's good. It was good to have contacts. It was good to have the social interaction of other intense thinkers. And yes, I think that's probably the second most valuable thing I got at MIT.
Mhm.
But, you know, I will say that, you know, in the 10 years after I left MIT, I worked 3,500 hours a year, 70 hours a week, 50 weeks a year, dealing with problems never before encountered. And I didn't think it was particularly difficult, because it was so difficult getting through those 4 years at MIT where I was working 80 to 90 hours a week, intellectually butting heads with the smartest professors, the smartest students, and trying to solve fundamental problems. I kind of felt like it hardened me intellectually to cope in the real world. And so I appreciate the fact that they gave me that kind of tough love. You know, they didn't give us a textbook with 37 questions with the answers in the back of the book and let us memorize the answers, take the test, you know, and give us a 95%.
Yeah, for sure. I mean, I take a little bit of a takeaway. You get smart people together that are curious, maybe curious being the key word there. They're actually not overloaded on that first day with too much information and afraid of what others may think if they speak their opinion and they're wrong. Unfortunately, that childlike wonder sometimes tends to go away from us as we age. How do you, it's kind of interrelated, how do you build systems that embrace volatility? I sound like Nassim Taleb now, and are meant to survive and improve with time.
You know, I think it starts just with an appreciation of the statistical nature of things, and the value of volatility and stressors to the health of a system. So I spent a lot of time studying natural cycles. And, you know, one part of MIT is the School of System Dynamics. And we studied predator-prey dynamics in nonlinear systems. And, you know, that's an example where I remove all the wolves from a system, all the deer, you know, explode, they destroy the ecosystem, they reroute the rivers, create erosion, and then the deer overpopulate. And when you study those kind of systems, you realize that you need to have a balance between the predator and the prey, and the wolves actually keep the deer at bay, and that keeps the ecosystem stable, and that's good for the vegetation, and that's good for the ecology. And you can model that mathematically. That's what nonlinear systems are. It's all about modeling feedback. And so if you develop an appreciation of nonlinear feedback and equilibrium, and you see that applied in nature, then you see it pop up in immunology, and then you see that it's the basis of all control systems and control engineering. Nothing flies without servo mechanisms, and you have to design stable systems that will return to a stable point when perturbed. If you get that, and you see all the thousands of examples in engineering and in nature, then if you're designing a product or designing a company, you can apply those principles. And also it makes you comfortable. You know, the basic that you take from a lot of Taleb's books is don't run from pain, right? Pain is information. It's a stressor just like anything else. And so if you want a robust system, you need to embrace volatility, embrace pain, and react to it, and trend toward an equilibrium, and not run from it.
And Michael, how old were you when you founded MicroStrategy?
24. I was 2 years out of MIT.
Wow. I suppose the question would be, what gave you the confidence to think that at that age you could go and start a technology company?
When I was 3 years old, my first memory was standing in a room, and it was like a Sunday afternoon after my parents went to church. And the Sunday afternoon ritual was people come over to the house for a potluck supper, and they all bring a dish. And so I was 3 years old, and I'm standing there in the foyer, and I know that the kids are supposed to go in the backyard. The adults with the food are supposed to drop it on the, in the dining room on the left, and the adults without the food are supposed to go to the living room on the right. And so I'm standing there directing traffic, and people come in, and I'm pointing them toward the left, the right, or telling the kids go in the back. And then there are some adults that are ignoring me. And all I can think is, what's wrong with these people? Why don't they know that I'm in charge here? I know what's going on. So I
That
would say it's genetic, right? I mean, it must be genetic. Nobody taught me that. I just kind of felt like I should be in charge.
that would be a good approach. Wow, you did that really soon after school. Looking back, you're currently, and I'm assuming for a while now, a public company. If you could, again, like I said about college, roll back the clock, do you think there would be some advantages to remaining private?
Um, there are advantages to remaining private, but there are advantages to going public. Um, I could reel off all the differences, but I think being public is introducing higher degrees of compliance and transparency and more requirements. In a healthy public market where there's access to capital in the form of equity or debt, then a public company is a more sophisticated corporate creature. I would guess, what are there, 100 million private companies in the world? There's like about 5,000 public companies in the world. Especially US-based publicly listed companies are the gold standard of integrity, because you have clear Sarbanes-Oxley compliance, clear accounting standards, clear disclosure standards, clear conflict of interest and corporate governance standards. So any large entity would prefer to do business with a publicly traded company, and any large investor would prefer to invest in a publicly traded company. And so I would say, on the margin, although it's popular to complain about the burden of being public, I actually think being public is good discipline. It creates good, mature transparency. And I was never bothered by the requirement of, say, quarterly filings. I think that when you have quarterly filings, there's a quarterly evaluation. It's a good tempo, good to have that discipline. If you didn't have it, then you would put stuff off for 6 months or a year or 2 years or 4 years, right? And you would always say to yourself, well, I don't have to do it this quarter, so why not just wait till next quarter because we're busy on something. And I think that lack of tempo and lack of rigorous discipline ultimately results in sloppiness. So I'm in favor of ceremony. Like we could cancel Christmas this year, but having Christmas once a year is like having a birthday once a year, it's the right tempo. I think there's a benefit to rhythm and tempo and ceremony and alignment, and those things generally create institutional virtue.
I'm going to leave it a little bit as an open-ended question. Take it where you may. Should we apply leverage to what's working? Investing, business, life?
Yeah, I think if you have access to leverage under favorable terms, yes. For example, if you want to buy a house and someone will loan you money for 30 years at 2.5%, you should take the mortgage. I mean, your choice would be to work for 20 years and not buy the house, or you could buy the house. And by the way, working for 20 years, but I would say especially there's two elements here. One is, what's the cost of funds, or what's the expansion rate of the money supply? If the money supply is expanding by 7% a year in US dollars, and someone will loan you money at 3% interest, you certainly should take the leverage. Because if you buy the $1 million house, then it's going to be worth $5 million, in 20 years, and you will have generated wealth. And if you don't buy the $1 million house, you will work for 20 years and the house will keep getting 7% more expensive a year. You'll never get the house. And in 20 years, you'll have nothing. So I think that in an expansionary monetary system, which describes our money system for our lifetimes, it definitely makes sense to take leverage in your personal life if you can do it under fair terms. Like I wouldn't say buy a house with a credit card with 14% interest, right? I wouldn't tell you to go buy $1 million of stock with 90% or 10x leverage mark to market every minute, because if you get 10% volatility, you get wiped out and you lose all your money. So I wouldn't say use mark to market leverage to speculate. That's a bad idea. I would use long duration leverage in order to live better. That's a good idea. And if you're in the real estate business, it goes without saying that you buy the $100 million building with an $80 million loan, you raise 20 million in capital. When the money supply expands by 10%, your building's worth 110 million, you generated 10 million in equity. You can refinance that, live off of that tax-free the rest of your life. You'd be a fool not to use debt in the real estate business, right? So,
For sure.
so I think across the industry, venture capital is a form of leverage when I raise equity. Public companies are using leverage when they sell equity to the public markets. Public companies sell secured debt and unsecured debt. That could be good leverage. Ex post facto, there are bad forms of leverage, good forms of leverage, and there are bad use of proceeds and good use of proceeds. If you have a good use of proceeds and you have a good leverage, you should take it. But if you have a bad use of proceeds, like I'm going to borrow money on my credit card and go gamble in Vegas, and I just lost the money and I owe the debt at 14% to a loan shark. Bad idea. Don't do that.
Taking the downside approach to that, you mentioned real estate, and I'm also going to, for a second, make you a hedge fund manager.
Yeah.
The real estate example you gave is perfect, and probably over time, 99% of the time will play out. But just sheer luck. A year before COVID, you do that. It's office space in New York. Now your property is worth less than you purchased. You're over levered. So there are situations where having liquidity or having optionality and waiting things out maybe for 5 or 10 years. I mean, no one strategy, even in real estate, is going to work all the time.
Yeah, you can make investments that don't pay off with leverage. If you have a 10-year loan, you have 10 years to make it pay off, right? So if you did buy that building in New York City, you want the 10-year or 15-year loan. You don't want the 3-year loan or the 24-month loan. Generally, short duration, volatile investments are more likely to blow up on your face than long duration investments.
And I'm going to make you an investor, which you
Yeah.
probably are, but you don't need to disclose that. Imagine I'm in Greenwich, Connecticut, the land of hedge funds. And imagine you're investing in hedge funds. Aren't you going to want a manager who has very strong beliefs in a limited number of selections? They're being concentrated, but you probably know there may be some additional risk with that. If you talk to a hedge fund manager and they have 300 positions, net of taxes and fees, you may be saying to yourself, why do I need you? You're basically a beta. You're passively matching the index. What would you look for in a talented manager?
Well, I guess what I would say if I start from portfolio theory is looking out over the last decade, the return on the S&P is 11.6% for 10 years running as of today. The return on NASDAQ 17%. The return on Bitcoin is 200% annual. The return on gold is less than 2%. And the return on long bonds like TLT, 4.2%. So my first principle is the cost of capital surrogate. The closest one is really the return of the S&P, which is 11.6%. It turns out that another version of the cost of capital is the rate at which the M2 money supply expands, which is pretty close to that, maybe 11% over that time. Before March of 2020, that was like 8%. And then we had about 24% expansion in the last 12 months. And so all of these cost of capital numbers get out of whack in the last 12 months. But if I'm going to invest, my first issue is can you beat the cost of capital 11.6%? Okay, because I could basically get 11.6% by buying SPY in the next 30 seconds and do it with a low fee fund. So I don't really think I agree with you, managing 300 different names, not likely. You're just creating another index. Doesn't make sense. So what do I really think? Here's what I really think. I think that if you look at the past 12 months, the S&P is up 39%, Bitcoin's up 582%, NASDAQ's up 57%, gold is up 2%, and long bonds are down 16%. So what do I think? I think that if your returns are less than the S&P 500 index, you're destroying wealth. You're diluting your wealth. Everything you invest in that can't return the S&P 500 is a wealth dilution. And I think if your returns are less than Bitcoin, you're diluting your opportunity. You could have got 200% per year before tax, tax deferred for a decade in Bitcoin. So if you're taking risk or doing something that's really different, are you going to get 200%? Because Bitcoin is an index against the cyber economy. S&P 500 is an index against the entire economy. I would just tend to be skeptical of any hedge manager. Like I probably wouldn't give most of them any of my money, because to tell you the truth, the single best screaming home run right now is to buy as much Bitcoin as you have risk tolerance if you want to get an outsized return, and then take the rest and just dump it in the S&P 500 and wait. Bonds are going to be a disaster because the cost of capital is now 39%. And the M2 money supply is 24%, 25%. So somewhere between 25 and 39%. I think the 39 is because the jerking around the S&P about a year ago, but let's even say 25%. So you got to get better than 25% if you're going to avoid being debased by the currency expansion. And you can't do that with a bond that yields 2% interest or 4% interest. So bonds don't work. Commercial real estate doesn't work because no commercial real estate has a rent yield of 25%. They're all capped at CPI, and they've got like a cap, they've got like a 3%, 4% yield. They trade like long bonds. So now you're into equity. And my answer is I wouldn't bother with equity, because for the most part, show me if the money supply is expanding at 25%, show me companies that are going to grow their cash flows 25% a year for the next 8 years. Not many, not many, right? I mean, so, I guess if you'd asked me that question a year ago, when the cost of capital was 8%, right? The money supply is expanding at 6.5 or 6%, and the S&P is doing 8.5% for a decade. If you'd asked me that question, I would have said, okay, well, find some money manager that's got a specialty that can beat 8%. And if you believe that, then yeah, put your money with them. Otherwise, put it in the S&P. And, big tech, that's an example. Big tech was beating the S&P, and Apple, Amazon, Facebook, Google, that all made sense. But I think if you ask me that question now, today, thinking from first principles, I have to say the Federal Reserve and the EU Central Bank have tripled the cost of capital. And that's made your investment decision much easier. What they've done is they put 95% of every company underwater. Most companies can't grow their cash flows 25% a year. It's literally impossible to do without taking on insane risk. And so why is Tesla working? Because people are looking for hyper growth that they think is not going to be, that's going to grow more than 25%. It's going to change the world. And if I don't like that, I go buy GameStop, and otherwise, what are you going to buy? Big tech? You can buy big tech, but they're all tech monopolies. Will Facebook, Apple, Amazon, and Google going to be able to, can they raise their prices 25% a year for every year for the next 8 years without regulators doing something about that? Maybe. That's your bet. Otherwise, Angela, I guess the real issue is, I would say the fundamental, most important question every investor has today is you take a spreadsheet and you write the years 2021, 22, 23, 24, 25, 26, 27, 28, 29 on it. And then you put in the percentage increase in the money supply that you expect the Fed or the EU central bank to print, and really just the Fed. And if you put in a number 0.00000, you're an optimist, right? And then you've got 1,000 complicated choices. But if you put in a number 15, 15, 15, 15, 15, you can't buy bonds, you can't buy real estate, you can't buy 95% of the stocks. And if you put in a number 20, 20, 20, if you think that the currency is going to weaken by 20%, all you can do is buy scarce assets, trophy assets, scarce art, Bitcoin, something which is not correlated to fiat cash flows, because everything else has been debased to the point that a million pages of information and strategy are all irrelevant. The models are all irrelevant. Everything you've learned in 30 years is all irrelevant. Best example, what are you going to buy in Venezuela or Zimbabwe if the currency collapses? It's going to work. And the answer is nothing. Nothing. If you're in Argentina and the peso slides from 3 pesos to the dollar to 150 pesos to the dollar, which is what happened in the last 10 years, there is no investment strategy, no money manager in Argentina, no portfolio of stocks, bonds, equity, derivatives, real estate, nothing which is going to work other than this one thing. You convert your pesos into dollars, you forward finance all your cash flows, you finance all your fixed assets, you issue as much equity as you can in pesos, you issue as much debt unsecured in pesos, convert it all to dollars, put it into a bank outside the control of the Argentine government so that they can't convert it back into pesos and debase it. And that's the only strategy. And what I've just described in a nutshell is the strategy of buying Bitcoin, right? Bitcoin's a bank in cyberspace. It's a hard asset. I take my money, I convert it to Bitcoin, I put it in a bank in cyberspace, and then I'm indifferent to how much currency gets printed by the Federal Reserve. And I've isolated my risk in that way.
That was an amazing, which I wanted from you. You beat me to the punch on some questions, kind of a economic lesson condensed in 10 or 15 minutes. I'm going to want you to add a little bit to that. I believe it was on Breedlove's podcast, and I stole some of your lines, so I do use them. I'll give you acknowledgement now about how for the super rich, which is definitely part of my audience at Family Office Association, if they believe that their inflation is increasing by the government-controlled CPI, they're fooling themselves. And some examples that you give were living in Manhattan, buying homes in Malibu, London, Paris, Tokyo, the Hamptons, buying art, buying assets that are now going up, scarce assets that are in demand, way, way more than probably even 10 or 15%. I know you just touched on a part of that, but if you wanted to further elaborate, and you also gave an example about how a dentist making a couple of $100,000 a year, which probably puts that person in the top 1 or 2% of income, has no chance in a traditional system of ever moving up the ladder, buying those kind of assets per se.
Yeah, this is where like the MIT education helps. Most problems solved in the real world, like fluid dynamics or thermodynamics or orbital mechanics problems, they're not solved with scalars, with a single number. They're not solved with arithmetic. They're solved with vectors, n-dimensional numbers. That if you're going to describe inflation, you can't describe inflation with a single number, like CPI is 1.8%. Inflation is a vector, which means that I can track the inflation rate of houses. It's 11% this year. I can track the inflation rate of luxury houses in Palm Beach and beachfront property. That's somewhere between, it's 25% in Palm Beach, it's 50% in the Hamptons. I can track the inflation rate of assets like shares of stock or bonds. The inflation rate of the S&P is 39%. So people, people tell themselves, oh, that's not inflation, that's return. This year, you had hyperinflation in assets. You had no inflation in consumer goods. But rich people tell themselves, I'm a genius. I bought assets that went up 39%. and those consumer goods didn't. Okay, you're captured in your own frame of reference. I can define any market basket of aspirational goods, products, and assets. Then I can calculate the rate at which they change over time. It's a vector. It'll change, it's changing with time. It's changing in space, right? The rate at which real estate in Palm Beach changes is different than the rate at which real estate in the Hamptons changes, for good reasons. So once you embrace that idea, then the question is, do you want to live in your parents' basement, watch Netflix, and order Domino's pizza the rest of your life? If so, the CPI is relevant to you. Or would you like to be wealthy or stay wealthy? If you wish to, if you wish to be wealthy or stay wealthy, then the relevant inflation rate is the asset inflation rate. And the best surrogate for the asset inflation rate is either the broad money supply, M2, which expanded 25% this year, or it's the S&P index, which is the most liquid thing. I mean, people said, oh, well, we printed money and there's no inflation. Well, there was instant inflation within minutes in the assets. When you print $1 trillion, the inflation flow, the money flows into the assets and the price of bonds goes up, interest rates go down. That's hyperinflation. In fact, if it costs $1 million to buy a bond that yields $50,000 in interest a year, because the inflation or because the interest rate's 500 basis points, when the Fed prints more money, they drive up the price of that bond to 10 million from 1 million. The interest rate is 50 basis points. You've got hyperinflation in the bond. You're just telling yourself a Jedi mind trick. I don't want to buy the bond. This is not the thing I'd want to buy, and therefore I don't care about the inflation. But to the point you made about the dentist, well, what do people want? Do they want a job, or do they want to never have to work again? If what you want is Social Security and you want to be able to retire early at age 40 and paint and live with your family and enjoy your life, you don't want cheap pizza, and you don't want free streaming YouTube and Netflix. That's patronizing. I don't want to work till I'm 80 and have cheap YouTube. What I want is to work till I'm 40, buy a bond, and stop working. And if I have to buy an asset. And so the pernicious issue is that the inflation rate of assets it was 8% a year from 2010 to 2020. It was 35% from March of 2020 to March of 2021. And if you're 21 years old and you've got a job earning cash, you just saw your assets inflate by 25 or 30%. That's the risk of inflation. So once you understand that, then you realize if you wish to preserve your wealth or to create wealth, the number that matters is the cost of capital, i.e. the asset inflation rate, which is equal to the S&P 500 index return or the M2 money supply, roughly speaking. And if you're not actually able to keep up, stay ahead of that, you're getting poorer. So if you're a laborer, if you have a job and your salary didn't go up by 25% in the last 12 months, you got weaker, you got poorer, right? The government doesn't want to use 25% as the inflation rate because they don't want to give every federal employee a 25% raise. And so they'll say, well, it's only 1%, there's no inflation yet. But then again, if every house in America on average, according to Case-Shiller index, went up by 11% this year, how is that 1%? Well, you just don't want to buy a house. That's not for you, right? These are not the droids you're looking for. It's patronizing, and it just reminds me of this one famous phrase. All of our research shows us we can't tell people what to think, but we can tell them what to think about. And so if I just repeat CPI, there's no inflation, there's no CPI, CPI is inflation, there's no inflation, CPI, there's no inflation, we're waiting for CPI. If I keep repeating that, you'll agree with me. But meanwhile, the Fed prints $1 trillion, the stock market spikes, and people don't say, oh my God, assets have inflated, there's hyperinflation in assets. What they say is, oh, we're brilliant, the stock market's going up, isn't that great? Well, it's not great for people with cash. By the way, here's the problem. It's not great for any company that's valued based on fiat cash flows. i.e. every value stock. If you have a stock value based on future cash flows, and if the discount rate is equal to the M2 money supply, and if it goes to 15% a year, you have to discount the cash flows 15% a year. And so what you realize is if you're printing money, all of those value stocks can't possibly they can't hold value. And so you're destroying the wealth in the equity market over the long term while you're goosing it in the near term. And ultimately, you're going to create this massive stampede to a store of value that is not real estate, that is not bonds, that is not cash, that is not value stocks, that is going to be what? GameStop, super high tech, high flyer, speculative stocks, the SPACs, and then that drives people out of the system. And so you have to then look at either gold or Bitcoin. And, the answer is Bitcoin, not gold. And if you bought gold, you got destroyed. But if you bought Bitcoin, you did well. And all of that's being driven by monetary policy.
I had a very prominent financial advisor on yesterday who is fluid in Bitcoin, a believer, and basically said, Angelo, you wouldn't believe how many millennials I have, whether relatively poor, middle class, or richer, where their investment portfolio, he said it with a little tongue in cheek, is Bitcoin and Tesla. And I said to myself, I didn't have the guts to mention it to him, given that they have a long time horizon, I'm not so sure that's a bad idea. Obviously, he implied they need more diversity. And in theory, they do. I get it. But if they have a 30, 40, 50-year time horizon, I'm not so sure that right now, that was the worst thing I ever heard.
It reminds me of a decade ago. I wrote a book called The Mobile Wave. And the mobile wave is all about how Apple, Amazon, Facebook, Google are going to launch billion user digital networks and dematerialize mobile devices, retail, news, information, etc. And I bought a bunch of Apple stock and I bought a bunch of Amazon stock back before it went up by a factor of 20. And all of these conventional money managers on Wall Street, they would all, hedge funds paying, charging 2 and 20, they would all try to give me advice. And their advice was, well, Amazon keeps going up. You might want to diversify out of that and buy some other retailers. And my answer is, 15, and you can find this on YouTube, I'm on the record, 15,000 companies are going to get destroyed by Amazon. There's only going to be one winner. And so if your diversification is selling the winner to buy the losers. And so people, you can put on a suit and a tie and you can say, I've been in the business 30 years and I'm protecting your money. But if your advice to the millennial is sell the winner to buy the losers, you're destroying their wealth. And the same is true with Apple. People would literally say with a straight face back in 2012, well, every time Apple doubles, we're going to sell half of it, and we're going to buy other computer companies. Well, you're going to buy IBM and HP and Dell Computer. And the problem with that is Apple's going to dematerialize all of them, and pretty soon they'll all be destroyed. They're going to zero. We got to the point where Apple was 150% of the earnings of the entire mobile phone industry, right? Which means that they made money and the collective sum of every other company in the industry lost half as much as they made. And it's not a complicated idea. In the digital world, if I can launch a network which will go to 1 billion people that can actually deliver them a product for a nickel over the weekend, that's like the most powerful thing in the history of mankind for creating economic value. You're going to diversify out of that. You're going to sell your Facebook, Google, Amazon, and Apple so you can buy a diversified portfolio of non-technology, traditional 20th century companies. And that's the same issue right now. I mean, the reason that the money managers are wrong to put 2% of their portfolio in Bitcoin is because they're investing 98% of their portfolio in wealth destroying fiat derivatives, right? It's like you're back in Argentina. I'm telling you that the peso is going to devalue by a factor of 100 against the dollar. So the dollar, look at the blue dollar rate against the peso. It went from 1 to 1 till it bought 4 pesos, and then 8, and then 16, and then 30. When the dollar buys 30 pesos, you're going to sell half of your dollars to buy back into the peso, because then it went to 60, and then it went to 120, and then it went to 150. And the fundamental thing you're missing is, if you're owning an investment which is derived based upon existing cash or the expectation of future cash flows, and if the currency is losing 20% or 15% of its economic power every year, you're just selling the winner to buy the loser, and you're putting increasing amounts of your portfolio into something going to zero. And it's hopeless, right? I mean, it literally is hopeless. I own the domain name hope.com, HOPE. I bought it about 20 years ago. I waited for something to do with it. Well, I found something with Bitcoin. Bitcoin is hope. If you go to hope.com, you'll see all of our materials, all of our research, all of my videos on Bitcoin. Those millennials that are buying Bitcoin are buying hope. And when they're buying Tesla, they're buying hope. And if you're buying a diversified portfolio of companies in Zimbabwe or Venezuela, it's hopeless.
I'm still getting questions in. I guess apparently people have a lot of kids in high school going to college or college graduating. I'll try to combine that one question. What would be one bit of advice? And I think you hinted at some already, but I'm going to ask it anyway. For someone graduating high school, about to enter college and afraid of what the future looks like, and someone who now isn't going to have the luxury of sitting back in college, and I hate to phrase it that way, but now out into quote unquote the real world. Is it relatively the same or very different? What would your advice be?
Well, my first observation would be, YouTube has uploaded millions of hours of useful stuff. You can learn anything on YouTube. If your kid didn't go to college, all they need is discipline and access to a computer and the internet, and they can learn it all online for free. The lectures that I took at MIT in physics are uploaded to my website. I have a free academy called the Saylor Academy, SAYLOR.org. And the mission of that organization is a nonprofit. It's just to give away education for free to everybody in the world forever. And you can get a computer science degree or a physics degree, and you can learn all this stuff. It's all free. And when you go online and you get to the physics class, the professor that taught me physics at MIT in 1983, he's teaching for free online on that web, and it's a better experience. My family's life savings for 200 years were obliterated in the first 6 weeks at MIT, listening to those classes in a lecture hall with 400 people. Or you could just keep your money and go online and you could listen to the same lectures. And he's talking about like Newtonian physics. It's 300-year-old stuff. I mean, Isaac Newton wrote Principia Mathematica hundreds of years ago. It's 99.9% of all the math you're ever going to need. Why is there a copyright on this stuff? Why is someone going to charge you $250,000 to learn calculus? It hasn't changed in 300 years. It should be free. It is free. So bottom line is, you can learn stuff if you have the discipline. If you go to college, fine, you go to college. I mean, to a certain extent, sometimes they hold you back as opposed to speed you up nowadays, because, if I'm watching the video, I can watch at my own speed on my own time frame. When I went to MIT, I had to show up 3 lectures a week, sit in a hall with 500 people and listen at their time frame, sitting in the back of the room, 50 rows away. So I wouldn't obsess over that. I think that degrees will get less important over time. I do think my other advice to any family, though, worried about the future is, look, there's a digital transformation. Here are the things that matter. Being able to code matters. Write software, being able to create software products. If you want to create products, then software engineering matters. You can learn to code with a $500 laptop for free online if you want, but that's one discipline. The second, if you're not a computer scientist, then a data scientist. Being statistically sophisticated matters. Learn how to evaluate information and figure out what information is useful, what isn't. So if I was going for a technical discipline, I'd look at one of those two. If I wanted to be non-technical, what matters is being able to communicate.
Mhm.
Right? So if you can't code, then you need to be able to communicate. And the importance of communication has exploded by orders of magnitude ever since we got to this modern podcasting era. Like the world needs people that are very articulate, that can communicate some useful insight and upload it to the universe. So you should learn to communicate clearly, concisely, coherently, focus on learning a discipline or a skill, and then find a way to communicate that thing. And then my last observation is, in addition to the digital transformation of the world, which says communications and coding are really important, there's a digital transformation of balance sheets. And the single biggest truth in the world is that 7.8 billion people are using toxic currency to store their value. And what they need to do is convert their treasuries from a toxic currency, which is losing 15% or more of its economic energy every year, to a perfected safe haven asset, of which the best in the world is Bitcoin. So convert your family treasury to Bitcoin, convert your personal treasury to Bitcoin, convert your company to Bitcoin. If you have an endowment, convert that to Bitcoin. If you run a city, convert that to Bitcoin. It's a very simple idea, which is you have the strongest asset in the world. You can't make any more of it. One day, billions of people will want to own it. They've all got to squeeze through this one nozzle. Every day you can buy $1 billion, $2 billion of it. It's a bank in cyberspace. If you're holding $1 million in cash, you're losing 150,000 a year, or you lost 250,000 this year in purchasing power. It's just melting away. And so everybody on earth needs to figure out, how do I convert or digitally transform my balance sheet from something which is debasing to something which is accreting? And once you understand that idea, then it becomes pretty clear what else you want to do with your life, because there's a million other things that follow from it, that'll keep you busy once you get that big idea.
I think you mentioned through your background in engineering and learning how to think for yourself have answered part of this, but I'll ask it a little differently. Basically, that comes down to how you make decisions. What processes do you follow when we're in a world where there's so much information coming at us? If you're in economics or finance, there's hundreds of different indicators that you could look at. How do you narrow it down to a couple that really matter?
I just think 99.99% of everything is noise. So for example, if you want to be laser-like in your focus and effectiveness, you got to think two things: focus and frequency. What is the right focus and what is the right frequency? So in terms of making economic decisions, I think the right frequency is annually, 1, 2, 3, 4, 5, 6, 10 years. Look at blocks of time like that, looking at the frequency and the volatility and the returns or metrics on assets by the minute, by the hour, by the day, by the week, or by the month, even by the quarter, are all kind of noisy. Likewise, I wouldn't look at 100,000 little minute assets. I would look at $1 trillion blocks. So there's $1 trillion worth of Bitcoin. It's up 582% over a year and 200% on average, compound annual growth rate, 200% for a decade. Those are two numbers that are valuable. There's 10 trillion in gold. It's up 2% this year and 2% on average every year for a decade. Just stop right there. That's a big insight. You can measure 1,000,000 statistics of Bitcoin and gold, every second. They don't matter. What matters is one thing is appreciating at 2% a year and the other's appreciating at 200% a year. Now, what about 6,500 other cryptocurrencies? Irrelevant. They're not $1 trillion. Okay, the S&P is $32 trillion, up 39% this year, up 11% on average every year for a decade. Well, what do I think about 5,000 publicly traded companies? Irrelevant. I mean, maybe I can have an opinion on the $1 trillion ones, Apple, Amazon, Google, Microsoft, maybe, but you want to pitch me 50 million ventures? Irrelevant. 50 million small companies? Irrelevant. 89 million small pieces of real estate? Irrelevant. The big ideas are NASDAQ, big tech is beating S&P. It's up 57% year over year. It's beating S&P for a decade. It's 17% for a decade. If you buy a portfolio of bonds, they were getting 4.2% a year for a decade. This year they got destroyed. They're minus 16%. Okay. That's all you need to know. Bottom line, bonds don't hold value. Big tech does hold value. S&P is the value index. It's the cost of capital. Gold is breaking down and being destroyed because it's an antiquated elitist store of value. It's a disaster. Don't buy gold, sell your gold. Bitcoin is the world's first digital gold on the world's first global digital monetary network. It's a paradigm shift, the first idea in 5,000 years. It's compressed air. It's electricity. It's hygienic running water. It's something new and different. If you don't understand it, then you should go and study it. Go to hope.com and watch some videos. You should study it because it is, in essence, strong money on a crypto network. And there's no reason it can't flip gold and go to 10 trillion and then replace most debt as a store of value and go to 100 trillion. And if it does, it's going up by a factor of 100. And if you miss it, it will be the greatest opportunity of your lifetime, and you will have missed it because you were too lazy to do the work. So it's like when we invent electricity, or automobiles, I'm sure someone said it's just a fad. What communication networks, newfangled devices. I'm not putting water in my house. Why would I want running water in my house? What if a pipe burst? New ideas. Not going to get on that airplane. New idea. Everybody thinks they love technology, but they like technology, when it's TikTok. They like little safe technology, Snapchat technology. Okay, now some real technology showed up. This technology made your money obsolete. Okay, that's a scary idea. You get one chance in your life to embrace a big technology. The technology is a digital monetary network, which is open to the entire universe, which is 1,000,000 times better than the thing that it's replacing. You figure that out, and then that will inform and drive every one of your portfolio and investment decisions, because it's the most profound thing that we've seen in 30 years. It's bigger than the internet, and 99% of the world still doesn't get it. They still think it's a speculative, dangerous, uncorrelated asset, and whatever. Maybe it's a tulip bubble, and you owe it to yourself to understand it's not a tulip bubble. It's monetary electricity.
And we're definitely going to get to as much as our time allows, but a lot on Bitcoin. My next three questions, and this one is going to relate to Bitcoin, kind of come from, I'm a big fan of his on Twitter, Jonathan Bales. So I do want to give him a shout out. We hope to have him on in a couple of months. Look him up. He's great. So you make decisions, I'm assuming, with conviction. What would cause you to change your opinion about Bitcoin and feel differently?
Well, I look at all these assets, and the real question is there something better? So there has to be something better. Like, what would make me sell Apple stock. Well, if you had a better mobile network, what would make you get negative on Amazon? Well, if there was a better retail network, what makes you get short Google if there's a better information network? If there's something better, otherwise, and I don't see anything better because
Could Ether be better?
no, because Ether is much more complicated. It's much less mature. It is not it's not a $1 trillion monetary network that's purpose built to be a store of value. Ether is attempted to be many other things, including the world computer and a smart contract platform. And it's going through a very rapid evolution technical cycle. So as it goes from Ether 1.0 to Ether 2.0, the entire basis of the network is going to change from proof of work to proof of stake. That introduces a whole host of questions. And so it'll be 3 to 5 years, probably 5 years after the Ether 2.0 upgrade before you can evaluate what it is. If you're a hardcore institutional investor, it's a different thing. I think that if you want to characterize crypto universe, you have one thing, Bitcoin, which is the dominant $1 trillion crypto asset network. It's in essence, if God created gold in cyberspace, he would have created Bitcoin. It's gold in cyberspace, but it's got none of the liabilities and defects of gold. It's an encrypted block of sunlight. You can move it at the speed of light. You can program it with 1 million transactions a second. You can use it as the base layer for the 21st century economy. It's completely transparent. You can't make any more of it. It's capped at 21 million. You can take delivery of $1 billion of it in the palm of your hand or hold it in your head. Okay, so never in the history of the world did we have such a pure form of monetary energy.
Should I be concerned that in theory, in their own way, governments could shut it down? How about too many miners in China, hash power, all some things that people bring up as potential challenges?
Well, once you understand it, you start with the observation that it's the most successful digital network in the history of the world, okay? It went from 0 to $1 trillion in 12 years. Google took 22 years, okay? Amazon took 24 years. Apple took 42 years. Microsoft took 44 years, right? So this is the most successful thing ever unleashed in the history of humanity from an economic point of view. So then the thought is, well, it seems like it's too good to be true. It's that good. Okay, well, will it be banned? Will it be copied? Will it be hacked? That's the question. In 12 years, it's never been hacked, right? It's been tried a gazillion times. No one managed to hack the underlying blockchain. It's the most secure database network on Earth ever invented, primarily because it is this decentralized network of SHA-256 ASIC miners. And
I was just going to mention that.
it's billions and billions of dollars of hardware, and the only use of the hardware is to secure the network. So it just can't be attacked in a conventional way. You would have to spend 4 years and $20 billion to attack the tip of it. And there's hundreds of millions of people that know you're not going to keep that secret for more than a few seconds before the community attacks back. So
I'm going to jump on that one a little bit. And economists who don't know about it look at me with funny eyes, but you're going to know because you're a cyberpunk. On 1996, SHA-256, basically my question is, did the NSA or an offshoot from the NSA create Bitcoin?
I think it was created by one or more of a group of engineers that were very adept in encryption.
Are you one of them, Michael?
No, I'm not.
Okay, I'll believe you.
And we don't even want to know who it was, but I don't think they're here anymore. I think they're long gone.
Long gone as if the government got rid of them or they're dead?
I just think they disappeared, exit stage left for the
Okay.
good of the world. And so it's clear that it was founded by people that were very deeply steeped in encryption technology and computer technology, but also in Austrian economics, right? And it's a masterpiece of monetary engineering. It's not the first try. People tried many, many times before, and certainly they tried to clone it thousands of times afterwards. It's simply the most successful crypto asset network in the history of the world, and it filled a niche. The niche is as a store of monetary energy, a store of value to replace gold.
Uh,
So I think we just got to come back to this issue of, will it be cloned? Will it be hacked? Will it be banned? It's not going to be hacked. It hasn't been hacked. Will it be cloned? People cloned it thousands of times and they all failed, because once $1 trillion worth of money decides that it's going to put all of its money in this bank in cyberspace, they don't need the number two. It's like there's a Facebook, there's a Google, there's an Apple. It's a path dependent thing. Everybody's decided $1 trillion of money and 100 million plus people. They've decided that Bitcoin is the bank in cyberspace. Once you've adopted that one protocol, then it has $1 trillion worth of energy behind it. Debating that is no different than saying, well, what if someone comes up with a better language than the English language? Can we get everybody in America to switch? What if I come up with a better standard railroad gauge than the standard 4-foot, 8.5-inch rail gauge? Can we get everybody to switch? What if I come up with something other than TCP/IP? People aren't switching from English or rail gauges or protocols or whatever, because there's so much economic inertia in the system. Like, what if we decided we wanted everybody to love, Buffy instead of Coke? Well, Coca-Cola is the world's biggest brand. Warren Buffett understands it. Buffett-Cola is not. And that's because if I destroy everything that Coca-Cola has done for 100 years, if I get rid of all the money, all the trucks, all the signs, all the inventory, everything, you still got to murder 5 billion people because they have in their head the idea that Coca-Cola means carbonated beverage I can drink safely, right? It's what's in the head. It's the brand. So Bitcoin is in the head of 100 million plus people as being money, but it's in the heads of billions of people as the safest, most standard form. And the protocol is built into 100 million plus people's lives and tens of thousands of companies. You can't get it out. So that's why copying it doesn't work. And then as for the banning, well, look, it's property. And in the Western world, in Western Europe and the United States, they allow you to own property. So it's a choice between Bitcoin and silver, or Bitcoin and gold, or Bitcoin and ETFs, or Bitcoin and other property. And it is, and it will be wrapped in AML KYC regulations, just like other properties you can buy. And that's what makes institutions comfortable owning large sums of it. But it won't be banned in the Western world because we have a tradition of respecting property rights. And it's already been normalized as property by the IRS, the SEC, the OCC, the CFTC, and other related agencies. I think that's really a critical thing. Some people will say, well, I heard it's banned in China or something. Well, actually, I'm not sure it's banned. It's hard to buy it, but in certain countries like China doesn't want you to get onto Google. That's banned. Facebook's banned. Twitter's banned. But that doesn't make Facebook, Twitter, or Google bad investments. So I wouldn't make my decisions based upon decisions that take place in China or India or Nigeria. I'd make my decisions based upon the prevailing view of the regulators and the society in the Western world. And I think that's come down very hard on one point. Bitcoin is property. Bitcoin is not currency. It is not a medium of exchange. The medium of exchange function is sitting with the fiat currencies, the euro and the dollar. The store of value function is migrated into property like gold, S&P 500 index, real estate, and Bitcoin and other sorts of things you can own. And I think that's a very stable, logical development for the society.
Will central banks cripple Bitcoin with their own incoming central bank digital currencies?
Yeah, I don't think so, because I think central bank currencies are in essence digital currencies as a medium of exchange.
Right.
They're probably more threatening to Visa and MasterCard and existing payment rails, right? Apple, Visa and MasterCard are payment rails. PayPal, Square, Apple Pay, Google Pay are all working in one shape or form with some of those other payment rails. If I had a digital currency, maybe I could move dollars around on a different network. Maybe I wouldn't keep my dollars in an existing bank. I would move them to the central bank. So stable coin are these digital currencies. They have an impact, but they're probably more threatening to conventional banking system, because when you buy a share of Apple stock or Tesla stock, you're buying it because you don't want to keep your money in cash. And so when the banks give you $1,800 of CBDC dollars, you're still going to make the decision, should I buy Tesla, GameStop, or Bitcoin? Nobody's going to keep it in CBDC dollars. I could keep it in dollars at JP Morgan. I can keep it in dollars at Apple Pay. I can keep it in dollars anywhere, but no one's storing their life savings in dollars. As a general rule, they're moving them either into ETFs, like ARK or S&P ETFs, or they're moving them into stocks, or they're moving them into cryptos, because they know that they're going to lose value every year sitting in currencies, right? So the CBDC, the central bank digital currencies, they're not really threatening to Bitcoin any more than they'd be threatening to Google stock, right? They're simply another way to move money around. And what will happen? I don't think anything will happen fast, because I think it'll take them 4 years to study it and figure out all the implications around AML, KYC. And I actually think that there are plenty of institutions, large banking and traditional finance institutions, that'll be, concerned and want to slow it down to make sure that it doesn't impact their business.
For sure. And we're going to come back and wrap up very shortly with 3 or 4 kind of rapid fire questions on Bitcoin and crypto. But there's 2 questions I want to get to. I mentioned before, Jonathan Bales, that reading his Twitter popped in my head. Michael, when you're doing something, there's only 24 hours in a day. That means you're probably giving up not doing something else. What stays and what goes? How do you prioritize?
Well, first of all, I'd say, just like with a portfolio, if I had $100 in the portfolio, every dollar that's not invested in Bitcoin is dilutive to your opportunity, and every dollar that's not beating the S&P is dilutive to your wealth. And so if you really want to maximize your opportunity, you want to move as much of your liquid capital as close to Bitcoin or the Bitcoin network as possible, because it is this monetary network that's going from $1 trillion, and presumably it could be worth 100 trillion or more, because the sum total of all money in the world is maybe $400 trillion worth of stocks, real estate, bonds, and the like. Half of that is looking for a store of value, and the other half, honestly, truly wants to be invested in stocks or bonds or real estate. We've lost price discovery in the financial universe. So the single most accretive way to use money or time is invest in Bitcoin, because you've got a once in a lifetime, once in 50 years, transformation where all of this $200 trillion of money sitting in analog fiat instruments is being encrypted and converted into a digital instrument, which is thermodynamically superior, right? That's the first observation. Time is money. Convert your money into Bitcoin or something as close to it as you can. And the second, time, Well, anytime you're spending, analyzing, it's like go to Venezuela, analyze every company, every piece of real estate, every bond index in Venezuela, and figure out which ones you want to invest in. And the answer, Angelo, is it's all a waste of time, right? Everything you're doing, if you're analyzing frequencies of a minute, a day, a week, a month, that's a waste of time. If I told you I know how it all ends, right? Once you know how it all ends, the only use of time is, how do I buy more Bitcoin? But take all your money, buy Bitcoin, then take all your time, figure out how to borrow more money to buy more Bitcoin, then take all your time and figure out what you can sell to buy Bitcoin. And if you absolutely love the thing that you don't want to sell it, go mortgage your house and buy Bitcoin with it. And if you've got a business that you love because your family works for the business, it's in your family for 37 years, and you can't bear to sell it, mortgage it, finance it, and convert the proceeds into the hardest money on earth, which is Bitcoin. So what I would say is, use all your time to acquire Bitcoin, finance entities and weaker currencies to buy Bitcoin, or educate yourself on why this makes sense if you're not sure. And then educate everybody around you. You know, if you're working for a company that's got $100 million in the treasury, you got to convince the CEO and the board of directors to convert the treasury to Bitcoin. That's the most creative thing you can do. That'd be worth billions to them. It's like if you were to say to me, Mike, it's the year 2000, you're in Argentina. What's the best use of your time? The best use of my time is figure out how to get all of my money converted into dollars and get it out of Argentina, because I'm going to lose 99.5% of the money if I don't. Nothing else matters.
Do you believe in the 80-20 rule, which I know could apply to Bitcoin, but I'm going to evolve that a little bit. Why not apply the 80-20 rule to the top 20%? That's 64% of effects for just 4% of the causes. And how about again and again, the multiplier effect?
Yeah, I guess I want to understand that better. Maybe you could elaborate.
Are you familiar with well, Richard Koch wrote about it, or Pareto's principle of 80-20, that 20?
I am familiar, but I'm trying to figure out, like, against what, for example, like, are you telling me to look at 20? There's 5,000 publicly traded companies. What I'm telling you is that none of them matter. I'm not telling you to evaluate 1,000 of them or 20% of them. Like, here, what I'm saying is, if you're in an airplane and someone punches their elbow through the window and it's depressurizing, and you have a million things you could think about or do, when the oxygen mask drops out of the space above your head, there's only one thing that matters: put the oxygen mask on. Like you don't need to overanalyze. There's one thing that matters a lot. So, you know, I'm not quite sure where to go with the 80-20. If you gave me a sample of things, I would tell you whether I'd look at 20%. But what I would say is, if there's 100 people in front of you and one of them has a gun and they're pointing it at you, that's the one to duck. Right?
That in and of itself, Michael, would be great advice. I'm going to go rapid fire on some Bitcoin-centric questions. You actually hinted at one of them a couple of minutes ago. With interest rates close to zero, why doesn't every corporate issue convertible debt basically at zero, buy Bitcoin, and then lend out the Bitcoin at 6 to 8%?
They should. The most screaming home run idea right now is you borrow $1 billion at 1, 2, 3, 5% interest, and you buy $1 billion in Bitcoin, which is yielding 200% over the last decade. It's a 200% arbitrage. I used the phrase from Archimedes, you know, give me a lever long enough and a fulcrum to place it on, and I can move the world. The fulcrum is Bitcoin. It's the hard point, and the lever is just leverage. And the best idea for everybody is finance your future cash flows in a weak currency and buy a strong asset with them.
Does the Grayscale trust going from a massive premium to NAV to a discount pose any unknown risk?
I don't think so. I think it's, I mean, the marketplace is now just arbitraging out the premium to normal, but if Bitcoin goes up by a factor of 10, Grayscale would be a good investment.
The Genesis block is unique because it has 50 Bitcoin reward subsidy that can never be spent. Is this symbolic, or is this part of what makes Bitcoin blockchain technically superior?
I think it's symbolic to a lot of people because there's a religious component to Bitcoin. But at the end of the day, Bitcoin is a bank in cyberspace with no more than 21 million units. And the value of Bitcoin is going to approach the sum of all the money that's deposited in that bank, adjusted for the fiat currency inflation rate. And so ultimately, take how much money is in the bank, divide by 21 million. If they did move, it wouldn't matter to me. If they don't move, it doesn't, it's better if they don't. But at the end of the day, there's 21 million Bitcoin. If $1 trillion is invested in Bitcoin, that tags Bitcoin at about $50,000 a coin. When someone buys another $1 trillion worth of it, the price is going up, and then the price is going up based upon the rate of monetary inflation because it's the safe haven.
Since Bitcoin blockchain is a dominant digital monetary network, will applications eventually be built on the Omni layer that fosters innovation in NFTs, igniting the Bitcoin blockchain to become the underpinnings of the Internet of Value?
I think there'll be an explosion of all sorts of layer 2 solutions. They're already there. Coinbase is a layer 2 solution. Binance is a layer 2 solution. Square and PayPal are layer 2 solutions. Grayscale is a layer 2 solution. Every company that ever plugged their product or service or mobile app into Bitcoin is a layer 2, and they're all facilitating millions of transactions a day on the layer 2. And then they're using the base layer as the underlying settlement layer. There are probably 10,000 companies that are plugged into it a big way. There'll be hundreds of thousands. There'll be billions of transactions in these layer 2 networks that ultimately will be settled on the layer 1 network, or they'll use the underlying blockchain as the fundamental store of value and integrity of the network.
Will Taproot make the Bitcoin blockchain fast and scalable?
We'll see. I think that over time, Taproot will make the Bitcoin blockchain better.
Could it compromise
I
security?
fall in the category of people that thinks the Bitcoin network is already good enough to hold $100 trillion worth of monetary energy, and we should make it better carefully and in a responsible fashion and prudently. And yeah, it should upgrade, but it doesn't need to go fast, and it's not needful of anything to be successful. So I wouldn't rush it, but I wouldn't stop it either. I would just be very careful in moving forward.
And I guess related to that question, does the Taproot compromise the security of the Bitcoin network?
I don't think it's going to compromise the security of the network. I think that the upgrades in Taproot will make the network better if properly implemented.
Norwegian industrial giant Aker ASA established a new firm called CT to invest in the Bitcoin ecosystem. They already have purchased 1,170 Bitcoin. Is this the beginning of the end of global trade settled in US dollars?
No, I think that the US dollar is going to continue to be pretty popular. I don't think it's going anywhere. I think that this is just part of the continual trend of companies adopting Bitcoin as a treasury reserve asset. It's really the beginning of the end of, if you want to look at something which is ending, it's the end of gold as a store of value. I think that there's $10 trillion of gold, and traditionally it's been thought of as a hard money, and I think that it's dying. It's being eaten by Bitcoin. And so what's going to happen is $1 trillion worth of Bitcoin is going to grow to be $10 trillion. And gold's going to return to its ornamental value as a source of jewelry and the like. And so you got to think of Bitcoin as digital gold. Bitcoin's not going to replace the dollar as the world's reserve currency, and it doesn't need to. I think people get distracted thinking Bitcoin is a currency. It's not a currency. If you know anything about tax, you know that when you move a currency around, you can't afford to incur a tax obligation. So if the IRS is going to tax you when you transfer $1 million of Bitcoin, then it makes it utterly impossible to use it as a currency. On the other hand, it makes it ideal to use as digital gold or a store of value. And that's where I think you'll see it. And what you're going to see there is more and more companies will do this. Hundreds more companies than thousands of companies will do this because it's just a logical base layer for a treasury reserve.
A question on concern of Bitcoin. Sometimes you hear the verbiage, it's coming, quantum computing. Should we be scared?
No, quantum computing is just like the boogeyman people throw out there. It doesn't take quantum computing to hack Google or to hack Facebook or to hack Twitter. Twitter got hacked last year without a quantum computer, right? But no one's selling their Facebook, Amazon, Apple, or Google stock. Apple's network got hacked. No one sold their Apple stock. If someone did have a quantum computer, 99.9% of the stuff in the world is attackable by Dr. Evil. Bitcoin's the last thing you'd bother with. You know, when they took over the Twitter network, they took over the president's Twitter accounts. I mean, they could have launched World War III if they wanted to. That didn't take a quantum computer. So I think that no rational investor stays up at night obsessing over the fact that their Amazon, Apple, Google, or Facebook shares will go to zero if there's a quantum computer attack. And Jeff Bezos and Larry Page and Sergey Brin and Mark Zuckerberg are not going to give up all their money and run and hide because they're worried about a quantum computer. The answer is computing technology is going to improve. And if quantum computing comes along, it'll be incorporated into the defense of the network just as fast as it's incorporated into attacking the network. I think it's an irrelevant issue at this point.
And perhaps the last question came in from a participant. There are lots of announcements of Bitcoin purchases. We can verify some in SEC filings, but some announcements, are they just an attempt to fuel the enthusiasm and generate more buying?
I think there's a lot more buying than gets announced, by the way. I think that tons and tons of organizations buy and they don't announce. It's only the public companies that normally announce because they're required to by regulatory statutes. I think that the right way to think about Bitcoin is, and people get this wrong all the time, Bitcoin's not a stock. Bitcoin is a bank, right? And the price of a BTC is not the stock price of the Bitcoin company. The price of a BTC represents all the money deposited into the bank of Bitcoin divided by 21 million, adjusted for inflation. So if I formed a bank, JP Morgan, and I put $100 million in it, and I had 100 million shares, the price would be $1 a share. And if people had to buy in when it got to $1 billion, the price would be $10 a share. And if it got to be 10x more than that, it'd be $100 a share. As long as I knew that you could never make any more shares, then the share price is just going to represent, in essence, the inflation adjusted book value of the bank. And when you look at it like that, you see that in the near term, you'll have volatility, day to day, week to week. But over the long term, the real question is how much money is going to get deposited in this bank in cyberspace. And the next logical step is for all $10 trillion that's in gold to get deposited, and then for people to start to convert their negative yielding bonds and their indexes. And so as that money flows, the price is just going to go up, and it's going to go up not because it's an estimate of future cash flows. It's going to go up because there's 10x more money in the bank, and therefore the price has to be 10 times higher.
And I know the audience may be wondering as we wrap up, Angelo, you didn't bring up too much about MicroStrategy, the 450 million months ago in the Bitcoin, what they did in the bond. Everyone knows that about Michael already. I wanted to ask some questions that were a little different, but you were certainly a pioneer with that, obviously followed by some other companies, one relatively well-known called Tesla. I want to be respectful of your time, but maybe in wrapping up in the last 30 seconds to a minute, if you could let the audience know, why you were such a first mover with that, and you obviously have been proven right.
Look, we had a company that was generating 75 million a year in cash flow with 500 million in cash, and we were valued at $1 billion. So I'll call it 1 times revenue plus cash. And we realized that we weren't going to need the cash to grow the business because we could do everything we needed to do over the web or via digital Zoom techniques and streaming video and the like. And we also realized the cost of capital was 25%. The Fed was printing more money, and everything that we wanted to buy, remember what I said, if you're not getting the S&P 500 return, is dilutive to your wealth. So the cost of capital went to 25%. And when you apply a 25% discount rate to your existing cash, well, that means that your 500 million is worth 100 million in 7 years. And so our existing cash balance was being debased at 25% a year. And our future cash flows were going to be discounted at 25%. And once you realize that, you realize, you could, if I work really hard, and if 2,000 people do 100,000 things right for an entire year, we generate 75 million in cash, and we lose 125 million in purchasing power in our treasury. So you see, it's literally the example of running as hard as you can to go backwards. The metaphor I give you is, we're in a rowboat, we're rowing across the ocean. The wind had been blowing a little bit in our face. We're making 4 or 5 knots. Then the wind cranks up to 25 knots. Now we're going backwards 16 knots. We're never going to make it. We're going to starve to death. What do? Well, we bought ourselves a $500 million Bitcoin sale. We put it up and we turned the ship around, and we went with the wind instead of against the wind. And we let the 25% cost of capital blow $500 million forward instead of rowing against it. Okay, well, our 500 million promptly doubled. We had $1 billion. Now, if you have $1 billion in capital and you have a 25% monetary inflation rate, you make 250 million a year in investment income. So what do? We forward finance the next $650 million worth of cash flow, because if we wait for 10 years to generate the cash flow, it'll be worth nothing, or it'll be worth 20%. So we might as well borrow now. So we borrowed 650 million. We bought Bitcoin with it at 21,000 a Bitcoin. Bitcoin had already doubled from our first move. So we bought again. Now we had about $1.8 billion Bitcoin sale. If the money supply keeps expanding at 25% a year, we're going to generate $500 million in investment income and operating income in the coming 12 months, because we're going with the monetary system, not against it. So that worked. Eventually, we had a chance to go back and raise $1 billion at 0% interest. We're paying 0% interest for 6 years. We buy $1 billion more Bitcoin. And so today, where does that end us with? Well, so today we have nearly $5 billion worth of Bitcoin. And if the money supply expands at 20% a year, that means we have a $1 billion investment gain a year. And we don't have to live in fear of the money supply expanding, because we have actually converted our company from asset poor, in essence, from a bunch of people in one of those galleys where everybody's rowing as hard as they can, dragging a 500-ton weight behind you. And we've converted ourselves into a clipper ship where nobody's rowing. Well, we're still rowing a little bit, but we're rowing with the wind now. And we've got the sails up. And if the money supply expands at 10% a year, then that's worth 500 million a year. And it expands at 20% a year, it's worth $1 billion a year. And so the strategy in essence is you can't create or protect shareholder value unless you deploy your assets in a creative fashion in the face of monetary inflation.
Michael, this has been amazing. I promised people it'd be an education and economic lesson as much as really about Bitcoin, and it was fantastic. I'll try to keep my close relatively very quick. I know you have a busy schedule. It's been great having Michael Saylor on, again, founder, chairman, and CEO of MicroStrategy. And Michael, that website was at hope.com or .org?
Hope.com.
I highly recommend it. Great from an educational perspective. So have a chance to go to that. And Michael's company is great too. Have a chance to look that up in terms of micro strategy. A little bit of some quick closing notes from me. Really an honor to have Michael on. What could I say? Amazing. Uh, Again, I will recommend people, especially those that are considering active in investing. I don't know at what time frame you're listening to this. It could be a video that we're shooting today, but it could be 3 years from now. Everyone has their own liquidity, risk tolerance, time horizons. Do your own diligence, make your own decisions. This is simply meant to be educational from our opinion and somewhat, I hope, entertaining, but you need to do your own diligence and make your own decisions. Think for yourself. Like Michael said earlier, all the time. We are getting back to doing some physical events. I have a intimate roundtable in Brickell in Miami coming up next week for 10 people. We have room for 3 more single family offices if you're going to be in Brickell, and it seems like every family office in the world is in Brickell in Miami. So shoot me an email. If you're hearing this on video, it'll be too late, but that's more for my live attendees. And again, I'm the host of the Angelo Robles podcast, founder and CEO at Family Office Association, a global membership organization primarily dedicated to the interest of single family offices. We're active as a thought leader, content provider, digital programming, physical programming. It's back. And really excited. Go to our website, familyofficeassociation.com, look into membership. We're very active on social media, specifically YouTube. We're simply Family Office or Family Office Channel. Go and subscribe. Thank you all so much, our live audience, those that will watch or hear this in my podcasting platforms as well on Apple and Spotify. Michael, thank you so much for your time.
Thank you.
Thank you.